Hi, Steve here from Promised Money. Today, as you can see, I'm in the pink, full of the joys of summer, but that's not what it's like in the financial market at the moment. So I want to talk to you about interest rates, what's happening right now, and the chaos that's going on in the market. Where are we now? We are mid-June. We're heading towards what's expected to be a rate rise, and it seems unavoidable. At the moment, inflation isn't doing what it should be doing. It shouldn't be leveling out, and it should be coming down more, and it's not. And there's only so much the government can do, and all they've really got to play with, the big lever, is interest rates. Why isn't it coming down? Well, one of the big factors is there's some big pay rises being forced through at the moment. That's pushing up inflation. So actually that's not helping. Waiting would help and then go for the big pay rises afterwards, but the unions are pushing them through now because they see this as an advantage to justify those pay rises. I get that, but it's not helping. And where we forecast to go in terms of interest rates, at the moment we're at 4.5%. Some are saying we're going to get to 6% now by the end of the year. Some are saying maybe 5 to 5.5%. But it was only a couple of months ago we were talking about interest rates starting to come down now. That doesn't look like it's going to happen because inflation hasn't behaved itself and has been exacerbated by these pay rises. So to give you a flavour, it was probably about 2.5 months ago, I was talking about if you are coming up to a mortgage switch right now, then don't wait until the end to lock your rate in. Lock it in now because you can always change it if rates come down. But if they go up, you can't. And I followed my own advice on that one, which was a good thing I did because it's probably about 2.5 months ago, I locked in my mortgage switch, which doesn't happen until the end of August, at 4.2. If I try to do that now, it's 5.27. So that is a massive, massive difference in terms of the repayment. So I'm glad I did that. And if you did that, well done. It was a good move. But the market is in turmoil. We've got lenders pulling out. We've got lenders withdrawing rates and then coming back with a wholesale rate increase. And that's been happening over the last week. Certainly, I've had one lender, commercial lender, they've increased their loan amount from $250,000 to £2 million overnight. That means they don't want to lend. We've had another commercial lender pull out entirely. We've had lenders, especially in the residential space, making massive increases because they are worried where swap rates are going. And if you remember, swap rates that's the rate that they can buy their long-term money in at. It's the rate that the country can buy money in at, if you like. Now, when we had Trustgate and all the issues back last autumn, swap rates went up to around about 6%, I think it was. And they came right down, and in March everybody was thinking, oh, this is looking really great, swap rates have come back down to some sort of sense of normality, it's going to be okay. But since then they've been creeping up and up and up, and they are not back to where they were this time last year, last September, but they are not far off. But that can all change because swap rates, they're very, very volatile. And depending on what happens with the interest rates on inflation, it looks so likely they're going to go up. But it depends how much they go up, and it depends on the inflation figures and whether that has an impact. They could come down quite quickly, which could mean that lenders feel a lot better. They can see the long-term money costing them lower, and their rates come down back down quite quickly. But we don't know. So if you're wondering what to do right now and you're thinking of taking out a mortgage, well, you've missed the boat. It's already happened. The lenders have already priced in what they expect to happen. If the base rate doesn't go up as much as people think, by probably 0.5%, that could, the lenders might then feel a little bit more confident. Swap rates might come down, but we don't really know. So your best bet is to sit tight right now. The government is targeting 2% inflation by the end of the year. That's been pushed way back into 2024. And now they're talking about maybe 8% in quarter 3, 5% by the end of the year. So unless that changes, I can't see anything much changing in terms of the current strategy to keep interest rates high and hold them high until those numbers, the inflation numbers, start coming down. So it's not great news, I'm afraid, for borrowers. and of course, as interest rates go up, that means loans become more affordable, which means you can't borrow on your income today. You can't borrow as much as you probably could have done 2 weeks ago or 2 months ago. So it's not great. We've just got to hope that inflation starts to come down. Stop going out and spending money. Let's slow the economy down, and stop pushing through big pay rises. That's so difficult to say because that's what people want to do. I need more money because the cost of living is going up. But by doing it now, cost of living is going to go up anyway because inflation is going to go up. So you get get it in your pocket in one hand, and if you've got a mortgage, it's going to be taken out of your pocket on the other side. And if you're paying rent, it's going to happen as well. So we've just got to let things calm down and gradually get back down to some normality. It's chaos in the mortgage market. It's bad news for everybody really, unless maybe you're a saver and you don't have a mortgage. But let's see what happens in the next week or so, because we're going to find out very, very shortly. But for now, sit tight. I hope you found that of interest, and hopefully it hasn't depressed you too much. As a mortgage broker and commercial mortgage broker, residential mortgage broker, yeah, I'm finding it all pretty depressing at the moment because it's getting harder and harder for us to service our clients. But hey ho, that's where we are. Catch up with you soon. Bye bye.